All right, let's talk about the Solesence Q2 2025 earnings call. This one is a real head scratcher, a total paradox. We're going to dig into how a company can post amazing numbers and still get absolutely hammered by the market. It's a classic Wall Street story about looking forward, not back. So let's get right into it. Okay, so check this out. On the one hand, Solesence comes out and reports what looks like an absolute blockbuster of a quarter. We're talking record revenue up a massive 56% from last year. You'd think the stock would soar, right? Well, nope. The very next day, it gets crushed, dropping almost 19%. So what on earth happened here? To really get it, you have to look at the two very different stories that were being told that day. So first up, let's dive into the story that management was telling everyone. And honestly, if you just listen to them, you think everything was perfect. It was a narrative of flawless execution, off-the-charts growth, just a total home run. The big number, the one everyone looks at first, was just spectacular. $20.4 million in revenue. I mean, that's a 56% jump from the same time last year. The CEO, Jess Janovsky, was practically taking a victory lap, calling it a total team effort and pointing to this massive demand for their stuff, especially their sunscreens during the summer rush. And this wasn't just some paper-thin revenue story. They were actually backing it up with some serious operational muscle. Just look at these numbers. They didn't just sell more. They were making and shipping a ton more, at a frankly staggering rate. Production volume up 127%. That tells you they were absolutely firing on all cylinders, just cranking out product to meet all that demand. And it didn't stop there. Management was also taking off a whole laundry list of big strategic wins. They got the company's stock moved up to the NASDAQ, which is a big deal. Then they got added to the Russell indices. Now, why does that matter? Well, those moves are specifically designed to get the company on the radar of bigger institutional investors. Plus, they locked down more financing, and this is a big one. They told everyone they had fixed all those pesky production problems from Q1. So, you can imagine the tone from the CEO was super confident, right? Almost celebratory. From where they were sitting, they had just pulled off a nearly perfect quarter. Which brings us to the big question. If everything was so great, why did the stock get absolutely wrecked? What did the market see that management was either ignoring or downplaying? Okay, now let's flip the coin and look at the other side of this. Because while management was popping the champagne, Wall Street analysts were digging through the footnotes. And they found a couple of things they really didn't like. The first red flag has this kind of boring name, the Employee Retention Credit, or ERC. But don't let the name fool you. Think of it like this. It's basically a government stimulus check from way back in 2022 that just now showed up in their bank account. And here's the crucial part. Investors see this for exactly what it is, a one-time sugar high. It's not real recurrent profit from selling stuff. It has nothing to do with how the business is actually doing. And this chart really just lays the problem bare. That one-time government check was for $1.5 million. That's almost half of their entire profit for the quarter. So when the market saw that, they did some quick back-of-the-napkin math and basically said, okay, let's just cut your reported earnings in half. That immediately made them question how real, how sustainable their profitability actually was. And then came the second red flag. And ironically, this one came from management themselves. In the very same breath that they were celebrating this amazing quarter, they turned around and warned everybody about moderating demand for the rest of the year. They started talking about a weaker economy, seasonality, tariff worries. And for an investor, hearing that warning about the future just completely drowned out all the good news about the past. So here we are, two totally different stories about the exact same 3 months. How do we make sense of this? Well, it really just boils down to one of the most fundamental rules of investing. Let's break down the disconnect right here. Management. They were looking in the rearview mirror. They were all about their amazing Q2 execution, their operational wins, all the stuff they just accomplished. But the market is always looking out the front windshield. They're focused on what's coming next. And what they saw was low-quality profit propped up by a one-off credit, and they heard management's own words of caution. So when it came time to vote with their wallets, they voted for a slowdown, not a victory party. And that's really the key takeaway here. A record-breaking quarter is fantastic, but the second it's reported, it's history. It's in the past. A stock's price is always a bet on the future, on what's going to happen over the next 6, 12, 18 months. And in this case, the market heard that warning about a slowdown loud and clear, and the reaction was immediate. Sell first, figure out the details later. All right, so with all of that context, let's put on our analyst hat. What are we going to be watching for in the next earnings report? And what's our official call on the stock right now? Look, the path forward here is really a classic bull versus bear tug of war. The bulls are going to tell you that the company's investments in automation will make them more profitable, that their cool tech will keep landing them big-named clients, and that being on the NASDAQ will bring in fresh money. But the bears, they're worried that a weak economy and those tariff problems are going to hit sales way harder than anyone thinks, and that the insane growth we just saw is simply not going to last. So, where do we land? For now, our rating is market perform. Here's why. The company has absolutely proven they can execute. They know how to run their business, and that provides a pretty solid floor under the stock. But those big economic headwinds and the cautious guidance from management themselves put a very real ceiling on how high this stock can go in the short term. We're basically in a wait-and-see mode here. And that really leaves us with the million-dollar question for anyone looking at the stock. Is Solesence a fantastic growth story that's just taking a quick breather? Or is this the very first red flag of a classic value trap, where the stock just looks cheaper than it really is? The real answer, I think, is going to be revealed when they report their next quarter. And as always, just a quick reminder, this is not financial advice. Everything we've talked about today is purely for educational and informational purposes.